company I sold for, $9 million. There's a 75% failure rate from heads of terms to closing. We get about 80% of our deals over the line. 40 years, Transworld's had a policy. We only get paid when the deal closes, so there are no upfront fees.
How many deals would you expect to close a year?
So my office currently is running 28 projects, and globally is probably going on 3,000. The only way I can describe it is a switch in the heart that goes off that says it's time for us to move on. That's my starting gun.
What do you find the differences are?
Three things really stand out. Number one has to be an obsession. Number two, they care deeply about their employees. The third thing really surprised me when I did this. Very few businesses don't sell with the right efforts applied that are over £1 million in profit, because there's enough of a cash flow for someone to do something with. So picking the right guy, even though the number may look a little bit lower in the beginning and I may get a little bit less money up front, is actually smarter, because the chances of a good outcome are much, much higher. I will tell you one of the biggest secrets.
Ken, thanks for joining us on the ownership journey.
Thank you for having me.
Do you want to introduce yourself and what your sort of background is in Transworld?
Sure. We are in the business of helping people that want to sell their businesses find good new owners for their business. We exclusively work in the small business sector, so generally under 20 million turnover. Transworld is the largest in the world at this activity. We're about 250 offices, about 15 in the UK. I'm an equity partner, and I run the Guildford office, where I have a team of about 6 people. So we help people that have decided they want to sell their businesses find good new owners and effectively sell their businesses.
Yeah.
But that's what the activity is about. So.
And how long have you been doing this in Transworld?
I've been at it for 8 years. Transworld's been at it for 40 years.
Yeah. And previous, you were in finance?
Yeah, so I started my career with Ernst & Young, and I was the equivalent of a chartered accountant in the U.S. And then I went in, I was in the early days of implementing accounting systems. Yeah. And then the company I did that for hired me to be a national trainer in the U.S., and eventually moved me to the United Kingdom in the early 90s. Yeah, and nice. Met the British lady and never left, basically. Yeah, and I went through the software industry, and so I was a software executive for a number of years.
And the difference between like M&A in US versus UK, there's more sort of regulation, and you've actually got a qualification in almost like a chartership in M&A effectively through Transworld. Is that right? Yeah,
it's AMMA in the U.S. So I'm a certified merger and acquisition advisor. I'm also a certified business valuer as part of this job. There is a lot more regulation for this kind of activity in the U.S. It's a bit of wild, wild west in the UK. But in many states you have to be also certified to sell commercial property and things like that. So they want to keep a tight rein on this activity. In this country, there's nothing, so anybody can do it.
Yeah, and how does Transworld work in terms of what gets done centrally versus what gets done locally? Because it's not a central center and command organization.
Correct. Yeah. If you think about the activity, what you're really doing is taking a journey. If you think about our clients, they're small business owners, so it's typically. My typical client is over 60, retiring. It's typically a couple, a man and wife, and they just need someone to help them on the journey of finding a new owner. And so the role we fulfill with them, one is we do this activity, all the time, all day long for years, and so we're good at it. But part of it is we're acting as a dating agent in the beginning, where we're finding that right new owner, and that's harder than it sounds, because you've got to find a lot of it's timing. A lot of it's finding people with the right backgrounds, because when people leave a business, they're leaving a leadership void, and you need to find someone to fill that leadership void, because the business has its own journey. It's not like selling a house or a car. So in the beginning, we're a dating agent. Once we find that perfect person, we then have like a 4 or 5 month process to manage. And so we always say we're project managing a wedding, and those are our two activities. So the actual dating agent part, we have a central packaging team in London that creates all the marketing materials. It's something we call an information memorandum and teasers and things like that. And we also have a buyer search team that goes out and uses AI and databases and all that and looks for just the right buyer. We can do international searches. They do about 5,000 reach outs a week in the UK So that's kind of the volume activity. Of course, we use our networks. About a third of what we do is with private equity. So we do a lot of private equity work, but it's just looking around just to find just that right buyer and the right timing. And so a lot of that is handled by the team in London because it's a bulk. These are bulk activities. When we find the perfect person, my team takes over because that's where it gets very personal, where we're dealing with the buyer and the seller, and you're managing a multi-month relationship. We're basically trust closes deals, and so we're maintaining trust, and we're project managing a million moving parts, to make sure, there's a 75% failure rate from heads of terms to closing in the small business sector in the United Kingdom. We get about 80% of our deals over the line, and because we focus on this activity.
80%. From heads of terms.
Yeah, we close ours.
So industry average is 3/4 fail, and yours is
80%
over 3/4.
Absolutely
succeeds.
Yeah. And one of the drivers for that is for 40 years, Transworld's had a policy: we only get paid when the deal closes, so there are no upfront fees.
So it's fully contingent. So you could end up spending a lot of time. On
and it can be several hundred hours. At risk. And so you get very good at knowing how to close these things. And I will tell you, one of the biggest secrets is to have the right, we call them new owners rather than buyers, because it's not like buying a property or a car. It's much more personal. So it's finding the right new owner in the first place. And there's a lot in that, but that's effectively in getting away from the highest offer mentality and the head-based stuff and more into the heart of, does this new owner have the right skills? Is the situation right for them to step in whatever role is needed from a leadership perspective? Not management, but from a leadership usually. And that takes different forms with different situations.
Yeah. So we'll go into the psychological part of it, but the scale of it, how many deals would you be working on? How many deals would you expect to close in a particular year?
So my office currently is running 28 projects, and there are 6 of us in my office. Transworld across the United Kingdom is probably 250, and globally is probably going on 3,000 projects at any one time.
Okay. So going to the process then, and you found that couple or people who are thinking about selling, what is going through their heads? Like what makes them say, right, I'm ready to move on from this business or share the equity or sell the equity to another set of people?
Yeah, and I think it's a good question. It is the biggest question, is what starts the process with me. And I've written 3 books. One of them was a book for new people selling businesses, and I found that was the first chapter I did in the book, is why and when people sell. My books are books on observations. I've done this for 8 years. I have over 15,000 hours of doing this one activity, and so you observe things. And I'm a chartered accountant by background. I'm a numbers guy, and so you would think you'd get a head-based answer about the economy or profitability or something. And in my experience, most of the time, it doesn't work that way. It's more the only way I can describe it is a switch in the heart that goes off that says it's time for us to move on. And that can take many forms. It can take it's time to retire, when one of the spouses could have retired from their other job and they want to go on cruise ships. It can be a move to another country. It can be an illness, or it can just be, I'm done with this. It's time for me to do something different. And we all know that switch. It's when we decided to get married. It's when we decided to move house. And then that's what drives it. And then that's my starting gun that kicks off my process, that these people are really ready to do what, and they're, even if the day they start with us, they're probably not leaving the business for 18 months because it takes 9 to 12 months to sell the business in a 6-month handover. So it's normally that switch in the heart that goes off, that kicks off our process versus anything intellectual.
Yeah. In most instances, people looking to retire rather than start something new, for example.
And you're dealing with the human condition, so there's a lot of scenarios. The majority are exactly that.
Retiring.
Yeah, they're in their 50s or 60s and want to retire. That's the bulk of my customer base.
Yeah.
I do have clients, quite a few over the years, that may have 2 or 3 businesses and they want to focus on another business. You could have a really good IT support company, but you've also got another company doing AI, for example, and it's really, really taking off. And your IT support company is a perfectly good business for somebody, and you want to sell that so you can focus on the AI company.
Yeah.
Things like that happen all the time.
And if you were to group the people when they first started and got into business, what's their journey in, because you must find out a little bit about what was the inception of the
course.
business. Yeah, so what are the types of journeys that people go on?
Yeah, no, it's a good question. Now, and again, I always have to emphasize, our world is the small business world.
Yep.
So that's generally under 20 million turnover. It's generally EBITDA, profit between 500,000 and 2 million. It's that zone. If you start getting bigger than that, you get into professional boards and professional management teams, and there's layers of this. So in the small business thing, we are getting the people that were the founders that are now selling. And always their stories are around, they've lost their job and sitting around a kitchen table and saying, could we start selling something? So we have this connection to China, and we can sell these specialist candles or something. It was one of a company I sold for, 9 million in, 10 years later. With tradespeople, it's very often, I've had people that are electricians, and they just were a bit more diligent than the other electricians, and the clients would say, hey, you're an electrician, you did a great job, we trust you. Do you think you could do some painting? So they do some painting. Do you think you could lay some carpet? And they continue to say yes and get their mates to help them, and before you know it, they're in the refurb. I've heard that story many times. I've had situations where, the restaurant owner just gets onto a concept and does really well with it, and then is able to, create multiple sites. But they started it with humble beginnings. Maybe their mother and father started the restaurant, and they took it over and professionalized it, and were able to expand. It's. I've heard the kitchen table story many, many times, where we just were out of options and had this idea, bulk selling on Amazon, that we're selling for probably 10 million. That started off on their kitchen table selling stuff because they had connections into China, and one of them actually moved to China, and they have their whole supply chain, and they do 10,000 orders a month now, and so these are the stories. So
this is really the entrepreneurial backbone of UK.
Yeah.
So and when you see people and businesses that have done well and attract higher valuations versus people who don't, what do you find the differences are?
So, and I've thought about this a lot and watched. 3 things really stand out. Absolutely, number one has to be an obsession, and I do mean obsession, with customer service and satisfaction. These people, and this is why people keep buying from them, is they care deeply, and it's just become institutionalized in their companies about the quality and what they're delivering to their customers. And remember, most of the time I'm selling a company, it's been around for a while, generally 10 years plus.
Decades.
And so they survive because of giving excellent customer service, and that's ingrained in that. So that's number one. Number two, they care deeply about their employees. They really, really take care of people. And again, most of the time, the people that are in the company, at the next level, have been there for years.
Yep.
And so they've built a really good team that shares their values and things like that. That's very common. The third thing really surprised me when I did this. They're all incredibly honest. They're very straightforward. I think they've learned that you can lie once, but the guy you lied to is not going to do business with you anymore, going to remember. And so I think they get it in them to they're honest to almost default, that they've just learned to be incredibly straightforward.
So thinking long-term rather than making short-term gains, maybe.
Yeah, short-term, long-term approach to relationships, and so being honest. And there's very little with most of them of fiddling the books and playing games and things like that. It's just, they just try to be honest. And it's not from a philosophical perspective. It's pragmatic. They just learned, if I'm straightforward and do everything honestly and do what I say I'm going to do, and I'm honest with the government when I file my tax, they survive long term. That seems to be a long-term recipe for survival.
Yeah.
One of the things they lack, I think that's important, is all of them have to have learned how to manage cash, because you wouldn't have survived that long. But many of them don't do it well. And many of them don't have good, what I would call financial reporting systems in place where they really understand the financial data. And one of the greatest benefits that I offer my clients, if they say, what's the one thing I can do to get better, is get a fractional finance director to come help you understand profitability on product lines, get a forward cash flow, and all that kind of stuff. So that's also shocked me, the lack in those areas. And you might say, how did they survive? And it's because they... Intuition. You got it. That's exactly the word I was going to use. And they just know it. But the problem is then all the knowledge is in their head. And so when someone comes and buys the business, it's hard for them to replicate that.
We focus on finance, but I suppose it's having those processes and structures and documentation around what they do, so that it's replicable.
Right.
Yeah.
And probably 2/3 don't. They haven't needed it. They have long-term people that just know how it all works, and they have intuition, but again, as you say, it's very difficult if a new owner comes in. So one of the things we ask them to do is to work on these things. So
in terms of when you come across businesses that want to sell and they struggle, like what are the attributes of those businesses? Obviously, one is lack of preparedness in terms of financials, but are there other things like second-tier management or?
So one is and it doesn't happen as often as you'd think, but if the books and records are unreliable, it becomes almost impossible to sell the business because nobody knows what they're looking at.
Right.
And so and when a new owner comes along, the money has to come from somewhere, and whether it's a bank or an investor or something, and that person's going to want to scrutinize some level of financial. You have to be. It's like an airplane. You have to be able to rely on the basic instruments. The altitude and the speed and things like that. And if you don't have that, people bottle out. No matter how much they might like the business, they can't trust what they're looking at, and so they can't trust that cash flow that's coming out. So ironically, for the businesses I sell, remember we're talking 10 years plus, have a reasonable level of reporting that we can ascertain what's going on.
Yeah.
So that isn't really an issue. The reason businesses don't sell, number one, is there's not enough profit to make it work for someone coming along to give them the number that they want. So if
It's
someone
become more like a job for.
Yeah, you're right. And when they leave, there's going to be zero profit because they're too important to the business. If you get somebody doing over £1 million in profit, it's very easy. Very few businesses don't sell with the right efforts applied that are over £1 million in profit because there's enough of a cash flow for someone to do something with. It's businesses that only have a couple £100,000 in cash flow that aren't paying the owners a market wage, and when you apply that, now you're down to 100,000, and it's just too risky. So there's not enough of a cash flow there.
Yeah.
That's the number one reason that we have issues. The other reason is if the owner leaves, there isn't a business there. I mean, that's a fundamental. If he's got all the relationships, or if the business has been based on his skills and things like that, that's not going to work because the thing you're buying is no longer that thing when the guy selling it leaves. And I think that you also have niche businesses that just people don't understand or are too risky. The other thing is customer concentration, if you've got one or two big customers that are doing 80-90% of your revenue, people can perceive too much risk. We have ways of mitigating that, by the way. So it just depends on the type of business. But if you get really niche businesses that there isn't, if we don't find a new owner that understands that niche business, it's very hard for them to buy it. There's somebody that's not from that sector can come in, like a very complex engineering business or something, unless we find someone that's been in that sector. The new owner is never going to be comfortable with it. They're going to think, I barely learned algebra in school, and here I am, I have to run this with advanced calculus or something. It's not going to work.
Yeah.
So,
and then if you look at the buyers, like what are the groupings of buyers, trade buyers, individual, like what does that landscape look like?
So there's three main types in my mind with subsections. Remember, we're looking for a new owner that can step into the leadership void that's left when my clients leave. This idea that there's someone in the business that can step up into that leadership is largely non-existent in the small business sector, in my opinion, on observation, 95% of the time. Wow. The reason is we call our owners X-factor leaders. They have a certain je ne sais quoi that allows them to run a company. And it's a multitude of skills, from people management to caring about customers to all kinds of things. And leadership is the ducking and diving you do. It's the new product line. It's the new direction. It's how you survive COVID. That's leadership. Management is doing the same thing over and over again. And generally what we find is X-factor leaders don't work for other X-factor leaders. And so when you look into these businesses, the people that are there long term are lieutenants. They're not the type of people that step into leadership. It's why there's been such a problem with employee ownership trusts. We've gotten a lot of them back. Is the guy leaves and goes and hits the beach, but his staff try and run the business and it goes fine for 6 months, but they can't make the decisions to navigate change.
This is EOTs.
Yeah. It's
so you find a lot of those fail.
Yeah, because of that, this factor. So what you're really looking for in a business sale is someone to fill that leadership gap somehow. Now, so you end up with three different types of buyers doing that. One is, let's start with private equity. The private equity guys, this is what they specialize in, is taking over businesses, and they will look for someone that may have been only a lieutenant, but they're very good at wrapping them up and putting a CFO in, giving that guy training, putting in very strong operational oriented boards of directors and things like that. And they generally are buying slightly larger companies. And so the people are generally stronger anyway. But they have their own way of doing that, and they understand that phenomenon. Sometimes they'll get people in from the outside. Often they'll put a chairman in, a gray-haired chairman from that sector to mentor someone that may have been a lieutenant. So you're not asking the guy that was lieutenant to step into the leadership role straight away. He may have a year and a half working under this guy where he transforms into an X-Factor leader. But they're just very good at this, and so that can work. PE doesn't want to buy, private equity doesn't want to buy every business, and so that's why only about a third of what we do. We like private equity. They have money. They know what they're doing. They're good. They're very good at growing businesses. Once they won't buy a business unless they can triple the value of it over 5 years, that kind of thing. We do a few transactions a year where the owner actually, maybe a younger guy, stays in the business, and he knows he's growing very quickly and doesn't know how to grow beyond where he is, and the private equity guys come in and leave him in situ. And those scenarios work very well as well, just to say. So he's not retiring. That's another scenario.
Yeah.
Okay, so again, the second category of people are trade buyers. Now, trade buyers are a no-brainer. If I'm a roofing company and I have a bigger roofing company that comes and wants to buy me, well, there's your solution. They know how, they have leadership de facto because they're a bigger company, and that smaller roofing company just gets moved in, and yes, everybody sort of becomes employees of the new company or a new division or something, but it's not such an issue. So trade buyers are great. The issue with trade buyers is timing. So imagine my roofing company example. If I have a roofing company in Surrey that's selling, I have to go find another bigger roofing company that has an appetite for M&A activity, has the money for M&A activity, and all these things. And so it's just like you.
So trade buyers are pickier.
Well, no, but it's timing. They have a business to run.
Yeah.
They're not thinking about acquiring companies all the time. Just like you're not thinking about moving house all the time. So I've got to get you in that 3-month window when you're actually thinking about moving house.
Yeah.
And then you'll read my emails about the 4-bedroom house in Guildford that's available. But if I send you that email 2 months earlier, you're hitting delete. If I send you that email 5 months later, you're hitting delete because your window is now passed. And so it's the same. So trade buyers are great, and we target them, but you got to hit them at the right moment when they have an appetite and they have the resources and all that. Because M&A activity is very time consuming, and digesting an acquisition is a big lift. And so a lot of times they're too busy running their own business model to be open to that. So, but we do try. So we like trade buyers, but you just got to hit them at the right time. The third type is a category of either an individual, or a team that comes in. And I guess you could say those are two different types. But so say you have my roofing company, and say you have a guy that owned a roofing company previously that got sold, and now he's looking for something else to do. Or he ran a roofing company in the north of England, and his whole family moved down to the south, so he sold his company, and now he's looking for a new project. He doesn't want to start from scratch again. All kinds of scenarios like that. Or you have teams of people where you have somebody that's good at finance, somebody that understands roofing, somebody that's in operation, that specialize in buying companies, but they generally will focus on a sector because the members in that team have that sector specialty. They can also be very good buyers, and we do a lot of work with them because they are focused. They're looking for this kind of a project, but again, they have the time to focus to be operators.
Yeah,
we have another category of people that were with bigger private equity firms. I have guys I'm working with that were with Rothschilds. They were with Lloyd's Private Equity. They leave those companies, and they've spent 20 years buying and building companies, but now they're doing it themselves, and they have, because of their skills, they have a lot of backers. They come with millions of pounds that these investors will put into them, and they're looking for their first project, and they have developed certain skill sets in a certain sector. Those are really good guys as well. It's interesting, every single one of those guys, when they start this, will not go and do what they did in their previous jobs and buy multiple companies. They will always buy one at a time and become operators for a year, and then buy another one and become operators in another one, because they've learned you've really got to spend the time filling that leadership void and making sure the business is on level footing. So the whole idea, I've decided, of being an investor at the small business level is not a thing. Yeah, and even the pros that guys who've managed billions and had huge successes come down and say, no, when we're doing this ourselves, it's one at a time. We have to roll our sleeves up and make sure for a year that business is on level footing. And so it's all about filling this leadership gap and working operationally with the business. Not management. It's more like a quasi-board level, but it's why we use the term leadership very deliberately, and not management. It's just making sure the business is on a level footing.
Yeah. No, that makes sense. So I suppose those three categories, when it comes to the valuation work and deal structures, come with different pros and cons and challenges and opportunities. How does the valuation process work and link to that? How do the deal structures come off the back of that?
Yeah, no, it's a good question. I think I've said I'm a certified business valuer, so I know the math, and I'm an accountant. But I don't think of it as we do valuation in this job. What we do is deal structuring. And because a transaction is never a number, or just a number, I should say, like a house or a car. I always say it's like a wedding cake. So you've got a foundational amount that's paid on closing day, which is the first layer of the cake. You've got another layer of the cake that's a deferred amount. And I always say deferred and debt start with a D. It's the easy way to remember it. And those generally encapsulate a core value for the company, and the deferred is paid out after the fact over time. You've got another layer on the cake that can be contingent on certain things happening. Hey, we just closed a big contract, and if it comes in, it'll increase turnover by 50%. We want to have benefit from that if it comes in. That's a third layer. Another layer can be rolling equity. Another layer can be service contracts. If the owner's staying around, you got to pay him some money. Things like that. So it's all about a deal structure, and the deal structure inherently risk runs right through. It weaves its way through M&A, and people have to meet and trust each other. And my clients, when they meet somebody, the level of risk goes up and down with how much they trust them, And so now, and remember, the first instance for us is finding the right new owner that's going to do a good job of driving my bus. That's going to be that my people, my company will go to its next level. So I found the guy I like, but now I kind of got to work where he is. And if it's private equity, it's easy. They have a lot of funds usually, and there's a certain deal structure that they use where you're getting 70% on closing and loan notes for the rest. It's a much more secure, so that's great. That's easy. If I get an individual, my guy, my roofing company example, he may only have so much money. He's perfect. He's going to be great. I love him. He's going to be great for my company. But he's only got a couple $100,000 to put into this deal, and we're going to have to engineer the rest with debt, and make up the difference with deferred. So we do what we can based on his situation. So we got to work with people where they are. If I've found the right new owner, now remember the failure rates. Offers are a dime a dozen in my world. 75% failure rate from heads of terms to closing. So anyone can make an offer, and anyone can say, oh, the valuation should be this. The reason we get to the end is we get the right people in the first place. And so I'm increasing the chance of closing. Also, if I get the right person, the chance of me getting my deferred payments after the fact greatly goes up. If I get the wrong new owner, even if I do make it to closing, 50% of transactions don't deliver on objectives after the fact. I may not get my deferred payments. And so picking the right guy, even though the number may look a little bit lower in the beginning, and I may get a little bit less money up front, is actually smarter, because the chances of a good outcome are much, much higher. And so you always have to evaluate risk. So people talk about valuation, which is a clinical mathematical exercise, sure. But then when you weave risk into it and you weave the chances of things closing, the client has to make a judgment call. Usually, the majority of my clients are more concerned. They don't say this, but they operate this way. That they get the right person that's going to do a good job running their baby, and the money becomes secondary. It's important, but it's secondary. So if we get the right person, they're normally quite flexible on how we structure.
And when you
deals.
say person, obviously the PE example or trade buyer example is probably not a person. It's probably a team.
It's probably
a team of people.
Right.
So having
team of people.
Yeah,
yes,
yeah.
Sorry, it's that category. The trade buyer, it's the same.
It sounds like you're not necessarily installing a new MD in every situation, but you're complementing the operational team with a board.
So it depends. Every situation is different.
Yeah.
Yeah. Installing a new MD almost never works, in my experience, in small businesses. Whether you're in a sales situation or not, the people that are critical to running that will rebel. And so you need it. They'll accept a new owner because you bought the business and you own the shares. Getting someone in from outside is usually very problematic, and it's not a good. People think it's a great. Oh, we'll just hire somebody outside.
Yeah.
It generally doesn't. Not.
So in most scenarios, you're complementing, augmenting the existing second-tier operational team, with finance or strategy or whatever
It depends. Yeah. But you're filling that leadership gap that's left when the guy leaves. And that takes many forms. Sometimes if it's an individual, he does become managing director. He may not even call himself that, but everyone knows he's the owner.
Yeah.
So he is the leader. Sometimes if it's a team of people, as you say, you're helping people that are already there and filling gaps. Absolutely. But it just changes. But the trick is to know that has to be addressed. And the strategy of hiring a completely new individual from the outside to be the boss of all these people
really works.
That have worked for the owner for 10 years very loyally is generally a recipe for a lot of people leaving. So
interesting.
Yeah.
And I mean, how is this over the 8 years? Have you seen the SME space and the buying and selling of small businesses? Has that changed, or do you see different challenges now than you did 8 years ago, or is it similar?
Actually, no, it's a very good question. I don't think a lot has changed.
No.
There are always profitable businesses. I had clients that made a fortune in COVID. I had clients that went bankrupt in COVID. Changing winds, an individual business or the economy as a whole will change. But in the end, we are generally working with profitable businesses. And there are always people that want to buy those businesses. There are lenders that want to lend into it. The characters change. It's a giant musical chairs. The lenders that are big one year aren't big another year. The PE firms that are buying one type of business. We just sold a big lift business about 6 months ago. There's a company that's accumulating those. This year it won't be lifts. It'll be something else that they decide to focus on.
Yeah.
And so, but the dynamic is the same. There are always companies making money, and there's a lot of money. I think there's $1 trillion of uninvested private equity money on the planet. And unfortunately, there's always the dynamic of, what happens when someone wants to go sell a business is they're entering an activity they've never done before. And so they reach out to the community to say, how do I do this? And there are people that exploit that will tell them, oh, if you pay me a $20,000 fee, I'll find you a great new owner at a ridiculous price. And the people that do that sell less than 10% of their businesses doing that. And that was in place 8 years ago. It's in place now. And it's a shame because people lose a year of their retirement with not much chance of success. So not much has changed in that regard, I think. I think the community as a whole is getting a bit more sophisticated. But I think the dynamic of successful businesses and people that want to buy them and the train rolls on, I think is I would.
Just going back to the valuation piece, just in terms of pounds and pence, like typically, how is just in layman terms, how generally is a business valued in terms of net assets, valuation multiples? Like what?
Sure. So there is math. I talk endlessly about people. The reality is there is math. There is, if I say this process is 80% heart, 20% head, there is head stuff. If you go on holiday, it's all about the holiday and how much fun we're going to have, but you better get the flights right and the hotels right and all the head stuff matters. It's foundational. But we always say when you're discussing a deal structure, the math is the starting point. Everyone thinks it's the ending point. There's not a God of valuation where there's a right and a wrong. One of the most shocking things when I did my valuation courses, remember I'm a trained chartered accountant, and is that they said this is 60% science, 40% art. And you never say art and accounting in the same sentence. So that was shocking. The other shocking thing was how valuation is forward-looking, and I didn't realize how accounting is backward-looking, right? Historical financials, historical tax returns, and all that. What you're really doing in valuation is you're selling a future cash flow. The future is the operative word. And so this, and people get a lot of wrong ideas, but once you get that, it's foundational. So I always sell what you're really doing mathematically is you're selling the future cash flow of the business. And my analogy is you're selling the future milk of the cow. Okay, you're not selling the cow, you're selling the future milk mathematically. This is very similar if anybody's been involved with commercial property versus residential property. And so what we do is the right way to do a valuation exercise is to take the future profit and imply an expected rate of return, which is normally in the low, say 21% for capital, and do a net present value calculation. Without the training for that, it's too hard for people to get their head around. And so we use these crude proxies called multiples. And generally the convention in this country is we use a multiple times adjusted EBITDA. By the way, the adjusted word is very important there. It's not EBITDA, it's adjusted EBITDA, because we have to add back all the pension contributions from the owner that reduce profit. We have to add back, we call them Hawaiian holidays and Ferraris, that they're putting through the business to reduce tax, which is fine. Yeah. But it's artificially reducing profit. That, if we're trying to figure out what is that future milk of the cow going to be, this is distorting it. We also have to subtract some things from that. If the owner's not paying themselves a market wage, and the new guy coming in is going to need to do that if they're not paying rent on a property because they own it, things like that. But we get to an adjusted EBITDA because what we're trying to do is show a new owner what their cash flow would be. Yep. And then that cash flow, and then what we normally do is apply a multiple towards that cash flow. And people say, but the other dimension to this is, over what period of time do you measure that adjusted EBITDA? And if you think about what are we up to here, we're trying to predict really what the next year is going to be after the guy owns it. So the most accurate thing for that is normally the last 12 months. Yep. So we still look at previous years because, businesses are different. I had a sawmill, and you could look over the last 10 years, and that would actually help you understand the trends. Most companies are in growth. So what happened 3 years ago is irrelevant. It doesn't tell you anything about what next year is going to be. Yep. I have some software companies where we have to look at the last 3 months to have any prediction about, I'm selling some GP clinics, and they spun up 3 new clinics 6 months ago. I can look at 1 month and multiply times 12 to give me a better idea than what the previous was going to be, because the clinics didn't exist. You have to use common sense to say, but you have to understand what you're up to here is understanding what you think the rate of milk of that cow is right now. Yeah. And that's your adjusted EBITDA number, and then you apply a multiple. Our data tells us that most businesses under $1 million get between a 3 and a 4 multiple.
3 and a 4.
Yeah. That's what our data tells us. And you can go into Gemini 3.0 and ask that question, the deep research one, and it'll give you a different answer. It says between 2 and 3. Right. Yeah, and so I just did that the other day. But that's generally, when you get over $1 million, you generally go that, the 3s and 4s go up to 5s and 6s and things, because there's a psychological thing. But it just depends. It depends, and multiples go up and down with risk. So that's the biggest thing. Why do multiples go up and down? Well, a business that has recurring revenue, where I'm pretty confident that revenue is going to come in, well, that's getting the 4s. And a business where the owner leaving isn't going to have such an impact, less risk, that gets a 4. Give me a building contractor who has to find a new client every time, and all the guys work for him, and they might leave when I buy the business. I might be offering him a 2.5 multiple, because it's super risky. So you just got to use common sense, and you can also do things like if you're worried about a large client leaving, you can do the deal based on the large client staying. But if the client were to leave within, say, a 3-year period, the deferred payments get reduced. And so there's all kinds of risk-sharing mechanisms you can put in. So deal structuring can get very, very granular. And so this idea of valuation with a number, in my world, is not a thing. No. It's specific to deal by deal.
And I suppose there's a continuum between total valuation size and the deal structure on the other end. So someone may accept a 2 times or 2 times multiple up front, or they might accept they might be offered 5 times multiple, but only 1 times upfront. So there's
the risk.
There's a balance of
yeah, because a pound in my pocket today is worth different than a pound that might come in 3 years.
Yeah,
Totally. And the other thing is people get confused about is, remember the future milk of the cow, but I have to deliver the cow. Well, the cow is all the assets in the business that produce the profit.
Yeah.
That includes the machinery, it includes the cars, whatever. It also includes the working capital.
Yeah.
So I only need enough working capital that the business doesn't run out of money after the sale. Anything more than that is stored profit and the owner can have it back. But I need to keep enough in that the business can run without needing more money.
Mm-hmm.
Now, sometimes people come to me and say, hey, that's great. Say there's a CNC shop. I've got a 500,000 pound cash flow. That gives me a 2 million core valuation.
Mm-hmm.
But I've also got 1 million pounds in CNC machines. I assume we add that on top. It's like, no. If you want to kill the cow, you can have steak dinner and sell the steaks off instead. But you can't have steak dinner and also have the milk from the cow. You got to choose. What its analogy is, we have the asset method of valuation where you're valuing the assets in the business and selling them separately. You can do that, but you're killing the cow. Or if you want to sell the whole thing as an entity, you're selling the future milk, but you do not combine these two. That's a big fallacy that people have. So
looking at the different components of the foundational cash, debt, contingency, I guess as part of the foundation, there's obviously cash, but if you're using leverage, so borrowing against the business or going to investors for a loan, like what do the debt markets look like? What's their appetite for investing or lending into the SME sector? Like, what does that look like?
So our experience is it's changing all the time. Part of my job, in my wedding project management role, is I bring a lot of people. M&A is a team sport. So I bring a lot of people in, accountants, lawyers, all that are all part of my contingent. We're just all trying to help get a transaction over the line. And one of those team members is what I call a lending consultant.
Yeah.
And so I bring a lending consultant. His job is to watch the weather. He's a weatherman and to understand what's happening with each of the lenders and who's lending and what criteria and all that, and guide people to the right place and make sure they do the right things to get the lend. I'm sure people have used mortgage advisors. It's a similar concept.
Yep.
And so that's their job to understand that. But my observation in the last year is that you have 2 kinds of lending you can do, basically. One is you can do asset-backed lending, where it's very similar to a property, where the bank will loan a certain amount of money based on the assets in the business. Now, the biggest asset in most business that banks are comfortable with is the debtor book. And generally, you can get 80% of the debtor book as a lend. Sometimes if you have things like CNC machines and all that, you can send a valuer in and you will get a portion of those. But it's not as much as people think. You're lucky, if you'll get half of that. And you generally don't get much on things like stock and anything else, to be honest with you. So the debtor book is the big one. So we look at a company's debtor book, and you can generally fairly easily get 80% of that in most situations, maybe even more. There's another type of lend called a cash flow lend, where they're loaning you based on the future profitability of the business. Mostly the banks don't like to lend under £1 million, and generally they'll lend you twice your adjusted EBITDA. So that means you have to be at £500,000 or £600,000 level of EBITDA had a chance of that. Now, what happens if somebody's buying a business is there's some criteria for this. One is they'll want to know, and the banks that do this aren't like Barclays and NatWest loaning on property. These are specialist lenders that are more like investors than they are banks. And so they'll evaluate, is the guy buying the business going to be able to run this business and pay me back? They'll evaluate the health of the business. They'll do an audit of the business, things like that. And so, but the guy buying it has to generally put in what they call hurt money. They generally have to put in 15% and very often have to give personal guarantees. So, for example, if we've got £600,000 EBITDA and we get a £1.2 million loan, they're probably going to want £150,000 of hurt money from the buyer and probably a personal guarantee to pay that back. And they'll give them a 5 or 6 year term loan on that money. Then what we need to do is make sure that the business is making enough money to pay that term loan back and also pay the deferred payments. So there's a cash flow element of this. And so really when we look at negotiating a transaction, we start off with the math. We start off with the multiple times adjusted EBITDA. That's the start, not the end. The second stage is we look at whether for that buyer the deal will cash flow. What is possible without the whole house of cards coming down. So, what will cash flow for that particular buyer? The third stage of a deal negotiation is just people deciding they want to do a deal a certain way, like it always is with everything. That's the stages it goes in. And I tell people when we get to that third stage, there is no right and wrong. And sometimes people get into this mindset, well, no, that's wrong. You can't know. If someone owns an asset, they can do anything they want. It's there. And if someone's buying, they can do and think anything they want in that third stage. So the math, to me, is purely advisory. Then we see if the cash flow works. And then the people just have to work out between them. If they really, really want to do a deal, if we find the right new owner and they really like each other, they'll figure out a way to do it with our help. That's our experience, and that's real life in our experience.
You must see, I guess, a full spectrum. There's not one size fits all, but how long does a typical deal from someone saying, right, I'm ready to sell my business, Ken, to closing take? What would be the shortest time? What would be the longest time?
Yeah, so if you think about the stages, stage one is we have to go through packaging, and that generally takes a month and a half. It doesn't have to, but we're creating the information memorandum. There's a recast where we're redoing profit. Usually they need inputs from their accountant, and there's a multi-review process. We have to do a 12-page brochure. So it generally takes a month, let's say, for packaging. Just because it does. We can get packaging done in a few days, but it generally doesn't work out that way. Mostly because the clients, it takes some time to review and get back and all that. And then we need to start the buyer search. So the buyer search team has to use their AI. They have to come up with a list of several hundred targets. They then have to find who in those companies you would target. They then have to find the emails and the phone numbers and DMs and all that. So it's quite a big lift. That's generally done while we're doing the packaging, but typically the buyer approval is done. All of it's done within 6 weeks, let's say. And then the buyer search team starts their outreach. We also start pressing on our networks. We're very well networked once we have the if we're talking to private equity, that's something we do is press on the networks. But the whole outreach process starts, and it generally takes another month or two after that to really start to get the meetings flowing. So, and we first meet with people. We qualify out about 60% the client will never meet. And for the client hopefully will only ever meet 6 or 7 people. Because we'll meet 20 per client. And so by the time that all happens, we're now into, and then generally there's an on-site meeting if we really like somebody, and then generally there's a deal structuring session, and we get to heads of terms. So that process, so we've a month to get the packaging done, and probably 2 months to go through meeting people and to get to heads of terms. Once we're to heads of terms, you then need to go through due diligence, and we run all the due diligence. We need to go through funding and post-sale planning. That generally takes another 2 months. And then if all that goes well, we then generally call in the lawyers. We don't like to call in the lawyers till later because they start costing a lot of money. And remember, we're working at risk this whole time. So everything I'm talking about, the client's not paying us. So we don't want to call the lawyers and have them start incurring retainers and things like that till we're pretty sure the deal's going to go through. And then when the legals come in, that's probably another 2 months. So, if everything is optimized, you're probably getting a deal done in 6 months, and throw Christmas or a summer holiday in there or whatever, but you can get a deal done in 6 months. The normal time frame is probably 9 months, and we also have to budget that some of them do fall through, and you have to go find another buyer and start the process over at different stages, and so that can extend it into 1 year. And then generally there's a 6-month handover period. We generally don't recommend people staying longer than 6 months because our entrepreneurs become entrepreneurs for freedom. And to suddenly have the last thing you do in your career to be working for somebody telling you what to do with your baby is just a prison sentence. And so we don't recommend engineering it. And so generally you want to be out within 6 months. And so that we generally say it's 18 months on average from beginning to end.
Do you find that in some instances maybe buyers had expectations of what they could get for their sale, or they have a second wind and then come back to you after a year or two? Some sellers go through sort of some phases of acceptance of getting to that stage.
All the time. And M&A is a very long process. I have The lift company I just told you about, we sold to private equity. We'd had them on our books since 2022 because they wanted a lot more money than the numbers would have. They ended up getting it because they held to their guns, and they also EBITDA went up, and so they said, let it. Okay, people go through the process. They get buyers coming in and realize they're only going to get a certain amount, and realize if they just work for another year, A, they would have the profit from working for that year. B, the business would be worth that much more, and they're willing to do it. Some people are just done. They need out, and they want to get whatever they can for it, and they're going to go. That's probably 50%, to be honest with you. Some people were in it for the long run, and we get them to list early and say, hey, we know you may not care if you sell within 2 or 3 years, but let's list now. Build the relationships with the people. And then, because when your EBITDA goes up and whatever, it's like dating. You may have met your future wife, 3 years ago, but you're rekindled with, there's a whole process that goes on. But the sooner you're on the market and meeting people and all that kind of stuff, the sooner you have a possibility that those relationships can turn into something. So that happens all the time. Also, what can happen is the financials can tank during the process. And so they say, oh gosh, we thought it'd be worth, we told you there were 600,000 EBITDA. It's tanked down to 200. There's no way we're getting as much as what we need to retire. We need another year. And so there's no problem. We're happy to roll with them for a number of years.
I suppose in some instances, buyers may get distracted by the process as well.
It's the human condition.
Yeah.
So we don't give up on people as long as they're honest with us. This can take a long time. It can be very quick. It just depends.
Yeah.
A lot of younger people that don't need to retire realize that they could keep their business for 3 years and keep the profit and then have a business to sell. So the math is always better to keep your business. That's why it's so important to understand this process is kicked off because of the heart switch.
If there's not an opportunity cost, as you say, in the instance where they've got an IT business and an AI business and they need to spend all their time.
Right. If they don't have that and don't have any other plan and they're just selling, a lot of younger people want to sell because they're fed up with the VAT reports, the HR issues and all that. What we then direct them to is to people like Paul Avens that will help them get out of boxes, delegate and all that, and get a better relationship with their business. And I've seen that work time and time and time again. If you have a good business, it's a wonderful thing to have. You've beaten the odds. 90% of businesses are not that. So you're in the 1 in 10%. And you're a young guy and you don't have anything else to do, I have entire chapters in my book talking them into keeping their business because mathematically that is always better. You can't beat it. If I'm getting you a 4 multiple, well, if you keep your business for 4 years, you'll have all that profit and still have a business to sell. What are you going to be doing for the next 4 years? So if there's not a reason to sell, don't. Now if you have an opportunity cost, by all means, but mostly it's, I need to leave because I need to retire. I need to leave. There's a reason for leaving.
Opportunity cost, or, if you had a hospitality business for sale pre-COVID, there's some unfortunate timing instances where, you could argue the best time to sell is now.
Yeah, exactly. And so it's highly individualized. But in general, if you're young enough and you have a good cash flowing business, you're better off mathematically keeping it.
Yeah.
And therefore, when people ask me, what's the mathematical justification for selling a business, I often say there isn't any. And this blows people's mind. And I'm a finance guy. There isn't. That's what I've discovered. There is no mathematical justification. You will make more money keeping your business. That is just the math. It's not an opinion. It's not philosophical. That is the math. So there has to be another life-based reason for you to want to sell your business. And that's important to understand, and it helps people a lot. A lot of people come into this thinking they can make more money selling their business than keeping it. It just is not, for most businesses, is not the case. Now, what some people do is say, I've got my business to a level, and I could make so much more money if I could be acquired. I would call it being beamed up to mothership, where someone could really leverage what I've done. The classic is the guy that's written the cool software program, and he gets beamed up into Facebook or something like that. And those are reasonable business models. So that is an exception. If you can be beamed up to a larger entity that can take some IP you've developed or some process you've developed and actually really scale it. Or if you're really on a growth tear and you're like, I've taken this thing to $1.5 million EBITDA, I think it could go to 5 million EBITDA. I don't know how to do this. Yeah, you can get private equity involved that can fund the whole thing for you and help manage your growth process. Those are very valuable, very valid use cases. And we like that. We call it the private equity journey, that, by the way.
And so the types of businesses, are some easier to sell than others? You talked about that recurring element, but as you said, you see a lot of trades and service type businesses through to restaurants, through to IT and software businesses. So
Yeah.
what you look at the whole spectrum.
Yes.
I guess all the principles apply, but are some easier?
Oh, yeah. High street, very difficult. Anything on the high street.
High street's difficult.
Yeah. Restaurants, very difficult. Too risky. And so we don't in my office tend to do high street anymore. We did for a long time. And so high street in this country is very difficult.
And that's fully owned, separate branded, as well as franchise, I guess, is it?
Yeah, all of it. Yeah, it's doable, but it's a lot of time, and a lot of them aren't very sellable. And the books and records in the high street businesses tend to not be great, and all kinds of things. So then you get businesses that require very high technical expertise, and where they've been built around an owner who has some technical expertise. Very difficult to sell because it's really based on that. And if he leaves, the innovation won't continue. And so we get businesses like that. That doesn't. Those are hard to sell.
So engineering.
Yeah, specialist engineering stuff.
Architecture.
Architecture is fine because generally you unless it's a specialty architecture built around one guy who's a visionary.
Yeah.
But I have had businesses that are like, I've had businesses that have designed the interiors of, I'm not going to name them, but some of the biggest department stores you will know of in London.
Yeah.
These are very famous people. So they build a company around themselves. Well, if they go, the vision's gone. They're like songwriters. You build a whole business around Oasis, but if Liam and Noel leave, there isn't an Oasis.
No.
There's a whole, so that's an issue. Lack of profit is a real issue.
Yeah.
If you're under 300,000, it's very difficult because they become the risk factor becomes very high that it could go down to zero and you start burdening in the owner's real salaries and things. You got two owners that have been taking dividends with 300,000 EBITDA. Well, to replace them is probably $100,000 each. Now I'm down to $100,000 of profit, and all it takes is for the wind to blow. Another businesses that are hard to sell, I can have a business that's at £1 million of EBITDA, and you go, that's really good, Ken. Yeah, but they're doing 50 million in sales, right? So the
Low
what we
margin.
call EBITDA margins is 2%. So generally, businesses that are private equity won't touch businesses under 10% EBITDA margin. That's 10% of sales needs to be EBITDA. I found if you have businesses over 5%, they're sellable, but any less than that, because the problem is you got 50 million in sales, $1 million in profit. If the wind blows wrong, suddenly millions of pounds in deficit you could be, and your business could be insolvent like overnight. So EBITDA margins matter as well.
And so as one end of the scale, the better businesses sell software, IT, recurring.
Obviously, recurring revenue, if you have long-term contracts, is great. SAS is the SaaS businesses is the ultimate. Think Xero. There are many of us use. Once you use Xero, you're stuck with it. And so those kind of businesses are worth their weight in gold. They'll get ridiculous multiples and things. Where they have an application they've written that people have signed up to that's very sticky.
Often, small businesses can be a family affair. Like, do you find father-son or mother-daughter dynamics? Is
a lot of
like
children in these businesses. So here's what we find. Remember, the businesses are always led by X-Factor leaders. That's one continuity. So, some X-Factor leader that's part artist, if you want to look at it that way, has built this business up. And generally the children are not, in the majority are not dad, let's put it. They're not X-Factor leaders in that way. Or they don't want to be. They've seen dad work all the hours the day brings for years, and they don't want that life. Or they don't have his talent. And one thing I always point out to people, how many of those children are playing in the Premiership? How many of his sons? None, because children, dad is something special, that X-Factor leader. The children are often in the business playing roles and often want a new owner to come in that can fill that gap so they can continue to play their role and have a job. That's the most common.
Yeah.
But so it's very common the children welcome the new owner, and we get the children involved in choosing the new owner. Remember, my clients are choosing the new owner. This is why we use the term dating and not buying and selling. They're choosing the new owner as much as the owner is choosing them.
Yeah.
And so we get the children involved in being okay with that.
Just thinking about the broader sort of legislative government side, is there anything you think? I'm just thinking about like US has SBA
Yeah.
loans, and it's a bit more identified that there needs to be continuity for a huge value portion of the economy. Is there anything you think the UK government or legislatively could be done to help this transition of, I guess it's really boomer value, isn't it? They've created all this value in the economy, and it needs to go somewhere.
I think two things. One is the SBA loan system, which allows people to buy businesses with very little down payment and is all government backed, is absolutely brilliant. It would be absolutely game changing if it were here, and it fuels an entirely different market in the U.S. It makes it very easy for people to buy businesses, and the government, I guess, has made some calculation that fuels the entrepreneurial level. It's highly risky, but it works. The second thing is stop threatening the capital gains tax on selling a business. It's not fair that somebody's worked for 20 years and you want to try and take half of, if they were to normalize the capital gains tax rates. Now, they haven't done that, but we're up to 24% now for a lot of it. And it continues to be under threat constantly. It's constant anxiety around this. And it just sends a message, that I think is the wrong message. And they've just done it on employee ownership trusts. They've just whacked out.
Doubled.
Yeah. Well, half of it is now not tax-free. And so at every turn, they're threatening. And it just sends the wrong message, I think. They should be enabling entrepreneurs and rewarding them for being the one part of our society that is completely dedicated to customer service and works much harder than most people to deliver the products and services that we all enjoy.
Yeah. It's an interesting point, because I think that there are all sorts of stats on mental health amongst founders and entrepreneurs versus the average in the population. Like, what's your experience? Because I think perhaps culture and sometimes thinks of business owners as takers, but like, what's your experience of the attributes and what business owners have to go through, to generate what they've
I think if
ended up with?
To be successful, by and large, it's a very competitive environment in the UK. You are delivering superior service and products to people, which we all enjoy. And you're taking a huge risk in doing that, and generally working crazy hours and dedicating a lot of your life to doing it. The entrepreneurial class is absolutely the engine room for innovation, for quality services, for new things. It's why it makes our society interesting. We should be rewarding these people. And the ones that are successful make a lot of money. For every one that's successful makes a lot of money, there's 9 that didn't make it. People don't realize that. They look at the ones that made it and think, oh gosh, he's made a lot of money. Yeah, but you should have seen, and generally the people that have made it have had some failures. They were the 1 in 9 that didn't make it, and they picked themselves up and all that. A very different thing than someone joining a big company and just having, a secure job as a career. And so if you make it, you get rewarded, and that's what motivates people to continue to take these risks, work all these hours, and be so, hell-bent on delivering a good quality service or product.
A couple of last questions. Is there anything you feel that people might want to hear around the world of buying and selling businesses that we haven't sort of covered in the last 45 minutes?
I think my theme is always realize what's really going on here, that we're trying to find a good new owner for your business that can help the business take its next journey and get away from seeing this as like selling a car or a house.
Yeah.
If you do that, M&A starts to work much, much better.
Just lastly, what do you love about what you do? What makes you, because you've done it for 8 years now, that's a substantial amount of time. I know you love what you do. So what is it about it?
This is a vocation for me.
Yeah.
And everybody has a role to play in the community. I'm meeting people at a major life change. If you think about it, next to getting married and having kids, selling a business is the biggest thing most of these people do. And that's when they meet me. And my job is to chaperone them, through a very critical life juncture, and I take it very seriously. And very often, the people buying the companies, it's a major life event for them as well. Okay, if it's private equity, it's not, but for the other buyer categories, even if they're trade buyers, the trade buyers are generally not that much bigger than the companies they're buying. This is part of their life journey. But more importantly, the people they're retiring, we're sending them off into another life change. And a big part of whether they're going to be happy sitting on the beach in Spain is whether there's a good new owner for their business, and they know that all those people are taken care of, and the customers and the thing they built is in good hands, and they're getting paid. And my job is to use all of our skills and experience to make sure that they have that outcome.
I don't know how much context. Just one other question came to mind. Being in the similar sort of space, I often find that people, particularly the technical owners, miss the thrust of business and sometimes retire and then come back in some form as consultants. But you're saying, go to the beach. But I think it's quite difficult for entrepreneurs to go, 100 miles an hour for 33 decades, and then do you find they often come back in some form and play some sort of role?
Usually, often they don't. Retirement for them is going and doing something they've been wanting to do.
Right.
Build a house, work in charity, go help people in Africa.
Yeah.
It isn't. I always use the
Sit
sitting on the beach as an analogy, but
Yeah.
ironically, that's not what happens most of the time. And generally, we find they only come back into the business because the new owner stumbles. And there's problems, and so they're dragged back in, and that's a shame, because that often means we haven't found the right new owner for the business.
Yeah.
And this happens very often with employee ownership trusts, because there is no new owner. There's just the old managers, and within 6 or 8 months, there's leadership issues that they can't cope with, and so the guys drag back in. We get a lot back where they go back in, they fix it, and come to us and say, we need to find a new owner. That happens a lot. Several times a year, I get clients like that were EOTs. It's not, the EOT is not the problem. It's the idea of the leader can just leave without having someone fill that gap.
Succession.
Yeah. So
Good. Thank you so much for coming on. Ken Gorman at Transworld will post links to where people can contact you.
absolutely.
Thanks a lot.
Thank you.